Is your interest rate less than 3%? Is it less than 4%? And you feel like you can't get out of this mortgage or you feel like you can't sell this home? What if I told you that you can't afford to stay in this 3% interest rate that you have today? Come on, let me explain. As consumers, we are having data and information coming at us from all different angles. It might be the internet where you're getting some information. It might be the news and what the media is telling us that you're getting information from. It might even be coworkers. It might be family. It might be friends. We're talking about inflation. Is it ever going to come down? Are we in a recession? Are we going into a recession? Interest rates are going up. Home values are going up. Is the Fed going to raise interest rates again? Is the market going to crash? Unemployment figures are down. Oh wait, unemployment figures are up. So what is the real data here? There's one thing that's for certain, and that is that it's very expensive for us today, and each one of us individually is seeing our expenses going up. So if we look at credit card expenses, for example, in 2022, the average interest rate on a credit card was 14%. In 2023, that same credit card has an average interest rate of over 22%. We're seeing that the auto loans today are over $800 a month. That's an average that has doubled over the past couple of years. We're also seeing 17% of these car loans today are coming with a monthly obligation of over $1,000 a month. So that is 1 in 6 car loans today. And we're seeing that these terms are getting extended too. So we're seeing a 72-month or an 84-month term, which we haven't seen in the past. So the fact is, people have a lot of debt. And what's the answer here? The answer is the equity in your home. Now, mortgage rates today are high. We all understand that. We're seeing that 40% of Americans today have a mortgage interest rate that is less than 4%. So it'd be very logical on the surface to say, we don't want to do anything with our current mortgage right now because interest rates are higher and it really doesn't make sense for us to do anything. That's on the surface. What if you could use the equity in your home to help you? We've talked with a lot of our clients and are talking with them every day about this strategy that I want to share with you that I'm going to run through. So we've done a case study on an actual past client of ours. They have grown out of their home, their family is growing, and they need a bigger home, what they're calling their dream home. So we've ran through the numbers with them, and I want to share this with you. So let's take a look at what this case study can help us learn. Okay, let's set the stage here with some numbers so that we can get a flavor of what this looks like and the strategies going forward. So current mortgage rate for our clients on their current home is 2.875. Today's mortgage rates, we're using 6.75 as a 30-year fixed interest rate. They originally purchased this property in July of 2019, and they paid $460,000 for the home with a 5% down payment. The value today, what they're looking to market the property at is $645,000. The remaining loan balance, I've rounded this number off. This is very, very close. They owe $399,000 on that loan currently today. Now they're going to incur some costs in selling the property. I've listed that at $36,000 so that they can pay the agents when they sell their home. The available equity is $210,000. Now, when they purchase their new property, they're going to incur closing costs on that. So I've allocated $12,000 towards that, leaving them with a total down payment of $198,000. Now, the property that they're looking to purchase, they've looked and they found the homes in the price point of $800,000 will get them the home that meets their needs for many years into the future and fits their growing family's needs. If we put $198,000 towards that, we would be financing $602,000. Now, what's the obvious problem here? It's kind of glaring, right? It's the bigger mortgage, so they're financing a lot more than their current mortgages today, and then the higher mortgage interest rates. And here's where the opportunity comes in. Now, if you don't have any debt, then this scenario really doesn't work. But the reality of the matter is that we all have more debt today than we had when we purchased our home. But first, let's take a look at this first strategy, and that is taking all of the equity that they have, the $198,000, and let's apply that right to the new mortgage. All right, what we see here is something that jumps right out at us, right? There's red, and red must be bad. Well, if we look at this monthly deficit here, this is a minus $2,523. What this means is that their monthly obligations with the new mortgage payment after they sold their current home, their budget would go up by $2,523. So that obviously is not something that's really something that they wanted to do. And as evidenced by on the left there, you see the back ratio, that red line. That is their back ratio, which is 65%. What that means is that their monthly obligations they exceed the guidelines and they wouldn't actually qualify for this scenario that we're talking about. The next one that I want to point out here is this 75%, the LTV, that's the loan to value. What that means is that $198,000 is a 25% down payment when they're purchasing their new home. The bottom half of this graphic here shows their monthly obligations, their balances, and their monthly payments that they're currently making right now. So one thing that we fail to do as consumers is, what is the interest rate on all of our debts? We know what our mortgage is, but what about the others? And what does it look like if we were to put them all together? So we've got 12% on our car loans, we've got 22% on our credit cards. If you've got a HELOC or a home equity line of credit, you're paying 9 to 10% in interest on that. And let's look at the blended rate. What would it look like if we put them all together? So that's what this graphic shows here, is what does it look like if we were to take some of our clients' debts here, add them all together with the interest rates, and figure out what the blended interest rate looks like. And what we're seeing here is the blended rate is 5.486. Now, it may be palatable to go from a 6.75% interest rate when you're looking at your blended interest rate being 5.486. So going from 2.875 to 6.75, that doesn't sound really that great. But going from a 5.486% interest rate to a 6.75% interest rate, maybe that's a little bit more palatable. And I'm using this one on purpose because it's not the greatest of scenarios, right? But it is one that can make sense for the near future, because this loan's always going to be refinanced. We're going to get you into a lower interest rate. And that's kind of the conversation that we've been having with our clients. So they're looking at this and saying, okay, this is something that might work for us. So what's the solution here? So the solution is, traditional thinking is to sell our current home, put all the equity into the new home. But what if we were to pay off some debt to make this look better? And now in this one, you're seeing a much different number. So now we're seeing that the big red number there, it's minus $220. So our client's monthly obligations here are $4,334. That's their monthly debts outside of the mortgage. So if we were to take some of these debts and to pay them off, and now we're looking at, look what this is doing on the left-hand side. We're seeing the back ratio is now 49%. We're now in qualifying range, and we're seeing that our loan to value is 87%. So we're putting 13% down in this scenario. So we're able to still qualify for a mortgage. We have a very small mortgage insurance premium that we're paying on this because we're not putting 20% down, but that is already calculated into these numbers. So look what this does. The budget is now going up $220. Now our client's response to this was, at $220, you are giving me the home that meets our family's needs and one that we can grow into for many years to come. But at $2,500 increase in our monthly budget, we just wouldn't be able to do it. So these are real life scenarios here, and we've looked at many of them. We chose this one to highlight here because I think it's more real life. We've looked at some of these other scenarios where saved the clients $850 a month, and $850 a month, that's $10,000 a year in tax-free money. And that's actually the difference between go out and getting a part-time job and sitting at home and eating dinner with your family every evening. So there's some real life-changing things that can be done done with these strategies that we're talking about here. And, in the scenario where they saved $150 a month, had they just continued to make that $850 a month on the mortgage, they actually would find themselves paying off the loan almost 7 years earlier than what they would have done if they would have kept at the 2.875 and made the minimum payments for those 30 years. So what that ends up doing is paying the loan off almost 7 years early. That had they been paying it at 2.875 for that remaining time, they still would have owed almost $200,000 when that mortgage was being paid off through the strategy that we're laying out here. So this is life-changing, and that's a great retirement plan for some people. The reality here is that each and every one of us needs to have an open mind here and be able to look at the opportunities that are in front of us. This may not be one that works for you, but the point is still the same. You need to get your information from the right source, making certain that you're making decisions that are the best decisions for you and your family, both today and in the future. So if you have questions, please reach out to us as we're putting these together for our past clients and new clients for that matter. And if you know someone that could benefit from this, by all means, please send this to them. And at the end of the day, we may go through this exercise with you and find that it doesn't benefit you in the way that you would like to see it work. But as we always tell you, at least we went through the numbers and you're making some sound decisions based on some real numbers. So somewhere along the way, we were taught when we sell our home that we have to take all of that money that we get from the sale of that home, and we have to put that into equity into our new home. And we're taught that any monthly obligations that we have to pay those off through making payments. If we're taking out a loan, we have to make those payments through our paychecks. So I want to change the thought process here, and I hope that you found this useful. I hope that you found it educational, and let us know what your thoughts are, as we would really love to hear from you and see what your thoughts are around this strategy of being able to purchase in a market that is increasing in value, increasing in rates, and one that we're going to be able to put you into that loan, that forever loan in the future when interest rates come down. So make it a great day, and let us know what questions you have, and please comment and let us know what you think.
We are the Hemry-LaSalla.